Hi, good evening, everyone. Uh, Welcome to another webinar with Valetax. Just giving some time for others to join. Uh, just giving a few minutes. Usually I have the 10 minutes rule before we get started. So we give others an opportunity to start the meeting with us and follow along instead of having to come back. But thank you guys for joining and thank you for exercising the future patients. Let's just give them some time to join in. Okay, good evening, everyone. Thank you guys for coming in again for another amazing webinar session with Valetax. As always, this this week on this webinar, the we're going to be talking about the secret behind every big trade. And the secret behind every big trade, honestly speaking, is market structure. Now, aside fundamentals and every necessary add-ons that needs to be that needs to be put in place when it comes to technical analysis, a major contributor, okay, a major contributor for your trading is market structure. In fact, market structure is the engine behind the market. Okay. So the car is built by the fundamentals and everything, but then
ماشي.
what al-
observation نقدر تزونا.
what allows traders as a whole be able to actually view the market and analyze the market properly is is by confidently applying market structure to their trades. So first off, let's go by introducing myself. So my name is Innocent Ifere. Okay. My
اسماعيل.
name, sorry, please, if you're on the call, could you kindly just mute yourself? Okay. Team host, if you're on the call, please kindly help me mute participants, new entry participants. Thank you. So my name is Innocent Ifere, popularly known as Ryan in the financial world. And I'm an educator at Valetax. I am the educator for Africa and senior market content specialist and market analyst here at Valetax. And one of the major goals I have is to help traders escape confusion with clarity. I have over 4 years financial market analyst and trader experience. Okay, so that being said about me, today is not just about me, but it's about impacting, you know, our audience with the knowledge. So let's go through the noise. Okay, I'm going to make the webinar as lecturable as possible so that it would be very much understanding and interesting for everyone. So before every big move, okay, there are a lot of things that happen. A lot of people attribute them to things like fundamentals, things like order blocks. Some people tell you it's because there was a fair value gap. Now, all of these things are really just trading concepts in the long run. But what is solely responsible for initiating the direction of the market or why these moves happen all relies on structure. So this is how you want to view it. You want to view structure as the overall plan of what the market intends to do. Okay. So without structure, you can't tell where the market is going to, you can't tell where the market is coming from, and you really can't tell why exactly the market is going to the direction it's going to. So those are like a major green flags that any, you know, forex trader should have. It's very important that you understand structure. So today what we're going to be learning is what market structure really is, why it is the foundation for every big trade, simple steps to reading it properly, not just like a pro. Okay, because I don't want to assume that everybody is just going to become a pro immediately after this class. But if you do pay attention to it and you study it effectively, you would actually study it like a pro. And then the common mistakes that you should avoid. So these are the major things that we're going to be learning today in this webinar. So sit back, put your seatbelt on, get your jotter, get your pen, and make sure to take notes down. Okay, so let's get started. What is market structure? So my definition is here to simplify it so I don't have to go over long definitions for us. So the overall framework for price movement showing how buyers and sellers interact over time and its direction target. So market structure enables you fully see and understand this tussle of power between buyers and sellers in the market. Candlestick kind of shows you that. Okay. But when a candlestick is broken down and is amplified, is opened up on different time frames, you tend to see the actual struggle between buyers and sellers in a more structural range. So when we go on the chart, I will show us that a bit more. Okay. Now, how do we identify structure? So major things that we want to look for are like the basics or the fundamentals of what structures entail. We have three different types of structures. We have a bullish structure, a bearish structure, and a ranging structure, which we refer to as an uptrend, a downtrend, and a ranging market. Okay. Now, an uptrend, basically, the core details you need to know about an uptrend is an uptrend is constantly going to make series of higher highs and make series of higher lows. By higher lows, we mean that prices are always going to move from a support and assume to do what? To break a previous resistance. In a downtrend, we want to see prices do lower highs and lower lows. That is to say, prices take the position of what? Of creating series of highs that fail to break the previous highs to the upside, but instead they tend to move downward. So that is lower highs. And for lower lows, it simply means that we see prices breaking every previous support. So in a downtrend, we want to pay more attention to the highs because why? We are looking for sell pressures. And in an uptrend, we want to pay more attention to the buys because we're looking for buy pressures. Whereas in a ranging market, it's a bit different. In a ranging market, we see prices stuck within two levels. Okay. So the variance, which is prices, are stuck between an equilibrium. So a static or a stable resistance to a stable support. And all prices is doing is bouncing off it back and forth, back and forth. And now if you look at my diagram properly here, you'd see that we have something similar happening here between a resistance and a support before prices eventually broke out of it. So this would be something like you want to refer to as a range. You can see price react at the resistance, come back to the support, go to the resistance, come back to the support. So assuming we had this continue in this direction, then we would say we are in a ranging market. I hope we're following. If you're following, just leave something in the chat section and say you're following so I know that we're following. Okay, thank you guys. Now, next thing is why exactly market structure matters. Why does it matter exactly? A lot of people just say structure, structure. A lot of people tell you the trend is your friend and all of these things. But we also need to really know why does it matter? You see, most traders focus only on signals, patterns, and indicators. Okay. But overall, proper technical analysis is not just about patterns or indicators. But for me, this is conceptualized in my own trading system and pattern. Is first to understand why, who, and where of price movements. And I'll break it down how I use these three things. So the first thing I want to know is why exactly? Because everything needs a why. Every big thing that happens needs a why. Why is it happening? Now, the next thing is who. Who? Who is the cause behind this thing? So there's a why. So if there's a why gives you reason. The who now is the participant. Well, who is responsible for driving these prices? And then now the question next is then where? So we have a why. Now we know why they are driving these prices. We know who's driving the prices. But now the next question we need to know is where? Where exactly is this price going to? Because if we can't tell where this price is going to, then you entering the trade is more or less like you're jumping into execution without direction, without a point of fulfillment. And that's where a lot of people also make the mistake. So you need to know why this market is behaving this way, who is making it behaving this way, and where do they intend to actually take prices to. Okay. So another thing you can also know it is just view it as it's the skeleton of price movement. Because what structure does is it allows you enter trades at low risk and high reward zones. It allows you predict where prices would be heading to and helps you avoid chasing the move. And if, for instance, you chase the move, okay, if you do really understand the structure and probably say you got in a bit too early, because you fully understand and have been able to define what that structure is, you can be more confident enough to kind of manage your risk and also understand that, okay, if I'm in the right direction overall, prices would actually stay with me. So I would not have to panic. Okay, I'll show you that on the chart as well. So moving forward is the three phase of every market and every market structure. Okay, now remember we said we have three types of structure. We have the ranging, we have the bullish, and we have the bearish. Now, the ranging, bullish, and bearish market structures always appear in the market, but a lot of people don't see it as much. And that's because they fully do not understand the phases of the market. Now, the phases of the market was described by Wyckoff, okay, a profound theorist of the financial markets and technical analysis according to price, phases, and cycles. He explained that the market has three phases, and that's why those three structures appear in the market. He calls the ranging market an accumulation phase. This is where buyers and sellers are struggling for a balance. They're trying to know who has the most strength to actually move a direction. Now, he then described the expansion phase, which is usually known as the markup phase, okay, as a strong trending movement when the movement begins. That's the expansion phase. Now, what you're seeing on my chart right now is more of a bullish example, but the bearish example can be the case. So it doesn't matter where the markup looks like, okay? If the markup could be markup could be bullish, and in the bearish version, it will be a markdown instead of a markup. Okay. So we have the expansion, which right now on this chart you're seeing is the markup phase. Then we have the distribution. That's where the trend weakens and reverses. Okay. So first we see the accumulation. A decision needs to be made. A decision is made, a market breaks out of that accumulation. Now prices starts to move rapidly and aggressively to the upside. Then prices get to a point where it is then a distribution phase. Why? Because the accumulation phase usually comes from why it's even referred to as an accumulation on the chart right now where you see it is because there is an accumulation of bullish orders at that very point in time. Prices then triggered orders, prices move to the upside, and we finally get to a supply point. At that supply point, prices start to slow down and weaken. When prices weakens at that point, then the distribution starts out. And then you have what is referred to as the markdown phase. So now we've gone from a bullish trend, we've kind of accumulated at that upside again, and then we've started to sell to the downside if you look at it very well. So these are like the three phases of every market, and that is why there's a need for you to understand where after you know the why and the who. Okay, so that's the reason why you need to know where, and it's very important. Now let's talk about how to read market structure step by step and how I view market structure. Okay. So when I open my chart, the first thing I like to do is I first want to identify what the structure is. Because without structure, I really can't tell where the market is going to and why the market is going to wherever it's going to. So that's why it's important for me to view structure first. So I tend to look at my structure from a higher time frame first of all, before I go to a lower time frame. Before I go to a lower time frame. And then what I do is I first try to identify the current trend. So I use the weekly time frame here because I was trying to get a full view of a good structure, and so that we have less noise. And I can also put that into a pictorial form that is clean and visible for us. So assuming this was not a weekly chart, take away your eyes from the 1 week chart and pay attention to just the structure on the chart. Okay. So what I would normally do is to first identify the current trend. I would mark out the significant highs and lows. Okay. Then I would also pay attention to the breaks of structures. Then I would wait for a retest before entry. So now, how do I identify the current trend? So like I said from the beginning, the basics of every trend is rooted in how the structure plays out. So this is what I mean. In a bullish trend, remember we said we want to see higher lows and higher highs. Now, why are these higher lows important? It's because the higher lows serve as a support level. They are areas that show valid supports for the market to continue bullish. Because in a bullish market, the supports are more important than the resistance themselves. So we want to pay attention, first of all, to the higher lows. So I want to view and see that the market is consistently making a series of higher lows to then signify and back my idea that the market is bullish. So if I cannot find series of higher lows consistently without each of them, failing to break the order, then it's not a bullish structure. Then it probably would be some sort of confusion that I now need to sit back and look deeper and try to understand what the market is doing. Now, the next thing I want to pay attention to is the higher highs. So by higher highs, I mean, I need to see that that every higher low creates a new higher high. That is the most important thing that validates the structure. So as much as the higher lows are important, I need to see that the previous higher low has already invalidated a previous higher high. So that is what I then note as the break of structure. Now, the break of structure are these things you see as lines on my chart. Are we following? Are we following? If you're following, just type Valetax on the chat section for me if you're following. Okay. So I'll go back. So this is a bullish structure. You clearly see that the market is doing what? Making series of what? Of higher lows to the upside. Now, next things next is we then want to see what a bearish structure looks like. Okay? This is what a bearish structure looks like. So a bearish structure is what is constantly making series of what? Lower highs to the downside. And now notice something about it. The lower lows are constantly being violated. That is one way you can fully identify that you're in a bearish structure. So it means that every support in a bearish structure is not a key level for you to be paying interest in, because at the end of the day, the prevailing strength in the market are the bears. And since the bears are very important, it means that structure is defined by who is in power, who is in charge. So if the bears are in charge, support levels are no longer your point of interest because the market is clearly moving to the downside. So I want to first identify and see that prices are what continuously creating series of lower highs to the downside. Then I can then identify, look for a break of structure, and then look for a pullback and wait for a continuation. And that is how you kind of identify market structure, analyze it, and then look for possible entries. Of course, you want to pay attention to things like liquidity, confluences from your indicators, and as well as your fundamental news before you decide on how you want to place the trade or where you want to take the trade from as well. So these are all important things. But today, the main focus is actually understanding how the structures are formed. Now, this is a common mistake that traders make with structure. Okay, pardon my typo error there. They tend to enter mid-trend without a structural confirmation. And here's what I mean. Because we see that the market is bearish, we're excited that it's bearish. So we tend to want to just do what? To just jump into the trade and then start taking a trade because we know it's bearish. But the truth about it is because the market has a face, okay, and there's this very common face in a trend that people don't, that a lot of people know, but sometimes they forget about it, is that the market is always going to be correction, impulse, correction, impulse. So this is what I mean. You see that for every time the market does a buy, okay, on this bearish trend, it comes down even lower and stronger. For every time it does a buy, it comes down lower and stronger. For every time it does a buy, it comes down lower and stronger. Now, the mistake a lot of people make is they tend to enter the market when the market or when prices are starting to become exhausted. So because they know it's a bearish move, they just jump into the trade without trying to identify if the market is exhausted, and they would need to wait for a pullback before coming into the market. Now, one of the things that causes this is because they ignore the higher time frame structure. So when you ignore the higher time frame structure, there's a tendency that you would always want to ride on the smaller time frame and then you get stuck on it. Because if you look at the smaller time frame, sometimes you might actually just be catching a pullback. You might actually just be catching a retracement. Because take, for instance, if this is the daily time frame, for instance, and you identify these buys here, you probably would have jumped into this buy somewhere around this level here and thought that the market was already buying. But deep down, if you do not deep the structure very well, you will not notice that this was only a pullback back into a level of support, because this support has been broken. So when a support gets broken, we need it to retest to become what? A resistance. These are basic, very, very basic price action strategies. Okay. So if you don't pay attention to the higher time frame, you could get lost in the smaller time frame thinking you're in the right direction. And that is the major cause and reason to why you hear a lot of people say, but I was in the right direction. And then prices came and took me out, stopped me, took my stop losses, and then I lost money on the trade. The truth about it is, yes, you could have been on the right direction, but the right direction to where and why? So the buys were not wrong, but you probably took a buy that you were holding for too long, whereas it wasn't really a buy trend or a buy structure. You were just in a retracement move to continue the sells. But if you had studied the higher time frame and understood the structure and the sole essence of what of how the market is behaving at that very point in time, you then understand that, okay, you should have been paying more attention to the sells because overall, that is where the strength of the market is. And you see, if you are taking the buys, there's no way prices would have come back for you as early as possible. Your account would have been gone. But now this takes me back to what I was talking about finding yourself taking trades at the wrong position, but if found in the right circumstance of structure, you might actually be safe. So assuming you took the sells at this very point here, so I'm just going to annotate here, okay? Assuming you took the sells at this point here and this market started to buy against you, because overall you are in the trend, okay? Because overall you've identified that the market has been bearish. Even if this buys came against you here, you would have a little bit of safety and consciousness to understand that this market is bearish overall. If for any reason this prices here would eventually buy and keep buying, it means that this level here would have had to be a very strong demand level from a higher time frame. But since you're overall on a bearish structure, you would have a glimpse of hope to understand that what prices would in fact do what? Come back to retest this previous support that was broken to make it become a resistance. And now you have some sort of leeway over your error, okay? And then you most likely would have just placed a bad but okay understandable risk and so okay, if anything prices fails to close below this level and stays above it, then I'm out of the trade. And then you could have held this trade and still come back and be in profit. Now this is why the trend is your friend. It's why it's important for you to always stay with the trend, because when you stay with the trend you're safer, because at the end of the day the people or the who with the biggest volume and majority in the market is always going to come back into the direction in which it has fashioned itself for. So you're always going to be safe. Are we following? Are we following? If you have questions, leave them in the chat section. If you're following, say I'm following, and let's just keep interacting until we get to our Q&A session. Okay? So yes, that is exactly what I mean by that's exactly what I mean by when you find yourself in the right trend, even if you're wrong, there would always be a way to salvage it. But when you're on the wrong direction and you're wrong, it is very important that you take your losses on time. Okay? Don't go holding, trying to catch a falling knife. Okay? Next. So when we talk about market structure, we're not only just talking about structure, but in order for you to utilize it well, I personally like to use a confluence of two major indicators: the exponential moving average, my RSI, and structure. Of course, when I look at structure, I'm not just looking at only structure, but I'm also looking at technical things within the market and prices that I use. I'm talking things like support and resistance. I'm talking things like demand and supply. And then I also pay attention to fundamentals. But when it comes to confluences on the chart, I tend to pair 2 to 3 things at the same time. So indicators are a bit slow. They would lag because they need to follow price action. And that's fine. But here's something. When an indicator finally gives a confirmation, your trade tend to have a more longer and bigger opportunity. Because when it creates a signal, it is because it has had to go through rigorous series of trial and error to finally catch the trend. And when it does that, it stays with it because it would have had to calculate a whole lot of, you know, previous outcomes to be able to forecast the future outcome. And that's one thing a lot of people don't tell you about indicators. As much as they lag, it is because they are constantly trying to calculate previous outcomes to try and forecast the future outcome. And when it does eventually forecast the future outcome and gives you a signal, that signal a lot of times would hold. Now, it is not just about the indicator, but it is also about you understanding where prices are at that very point in time. Like you can see on my NASDAQ chart here, you can see that prices was what? Prices was situated at a previous demand level. It had acted as a support as a resistance here. From previous times, it has also acted as a resistance as well. So what do we see? We see price do what? Touch it twice, and then we also get this exhaustion here. We see the RSI where the RSI hits the 70 level, which is also a good overbought level. We see that the market has hit 90 several times here. So the market has constantly been trying to correct itself for a very long time, but has not gotten the opportunity. And then we finally create a solid demand at this level. And after creating that demand at this level, then we also have the confluence here on the indicator. But not only, but there was a fundamental that drove prices to the downside. This was exactly when the tariff issues came on board. And it was tariff, 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 tariff. And we already knew what happened. Due to the tariff that Trump was trying to impose on other countries, we knew how it was going to affect the American companies and how it affected their stocks. Because if he was going to place a lot of tariffs and ban on imports, in bulk and majority of the American goods and services are produced outside of the US. So automatically, investors and everybody started to panic from the market. And that exactly was what brought to the crash of the NASDAQ 100. So you see that it is at the end of the day, being in the financial markets, your ability to be able to understand these little things and creating some sort of discernment around them. That way, you sit and see how the market moves and then you watch. You don't have to jump in immediately, but you have to learn. At every point in time, you're going to have a learning curve. You don't have to know everything. Sometimes you just have to sit out, watch, and learn. Okay. So that's that for market structure and confluence. And I hope so far so good. We are following and we are enjoying the webinar so far. Okay. And if you are yet to get registered or signed up with Valetax to start trading with Valetax, I do implore you, I really do implore you to head to your web browser, type in valetax.com, very easy, and get signed up. We have the best ECN account that any broker can give to you at
something big. It's gay class. You are using your data. Ah, just wow. Amazing.
Alpha, we get Alpha. Get this one will feed up.
So please, if you're on the call, please kindly mute yourself. Please kindly mute yourself if you join the call so that we don't distract others. Thank you. So that is that for market structure and confluence. Okay, so let's head to the next thing on our slide. Good. This is the part that I know we've all been waiting for, how to analyze structure. Okay, so let's head to the charts and we can actually see how I analyze structure. And step by step, I'll show you how I identify structure, my entry trigger, my risk management, and we can also see how it plays out. Okay, so I'm going to share my screen again. So just stay on the call so we can head to my charts. If you stayed thus far, I really do appreciate you and keep enjoying. This might be the turning point and change that you've been searching for in your trading. Okay. Yes, I want to believe we can all see my charts at this very moment. So, yes, okay, so let's go to So I already have an analysis here, but I'm just going to clear this out, okay? So when we look at USD CHF now on the daily, okay? So starting from this very point here. So what I like to do when I come to my chart is I like to identify key levels. And one way I identify my key levels or higher time frame support and resistance is first by pinpointing turning points in the market. So what I mean by turning points in the market, you see those areas in the market where prices just got to and then slipped. Okay, those are areas in the market where you get that distribution or you get that expansion from. Those are turning points in the market. They are very important to pay attention to them. Okay. I like to pay attention to them. So that's the first thing I do. Now the next thing I want to do is within the first two, turning points I get, I then want to start to identify the structure. So what I can see right here now is I see the market slipped up here, and then there was also a support at this level. So something happened next. Prices tried to pull back up, and then this level held it off. Why? Because this level also identifies as a key level, because we see what? We also see a turning point at this level here. We see a turning point at this level here, and then prices stopped at this level here. So that was a key level. And then from that very point in time, we then started to identify what? Sell structures. So this is me identifying. We can see that none of these highs broke above themselves. Instead, they were constantly creating what? Lower highs to break previous support. This did not break previous support, and it also did not break previous high resistance here. So it means what? This sell structures were still valid. So this is then what we would then identify on the weekly time frame as what? As a double top when we go to the weekly time frame. And then this would then be the neckline of the double top. So we saw that this previous low here that created this lower high here as well has not failed to be broken. So what happened? This finally broke it. So we also have what again? Another break of structure here. So it's clear to say that we are in a bearish market. So now, after knowing that I'm in a bearish market, when I come back and I zoom in, then I can then start to then mark out key levels. So this, mind you, this structure identified here on the daily, you can see it's like series of months. Okay, so this on the monthly time frame is just going to be like a very small structure. Okay, so I can then easily identify and say, you know what, since this two levels here acted as a very good demand to push prices up, this would serve as what? As a very good support level that has been broken. In fact, a very good demand level that has been broken. So there's going to be a need for it to become what? To become a what? A good resistance level. And that, in fact, was what prices did. When prices came into that level, what happened? It held off and acted as a good resistance level at this point, and prices fell through. Now, why am I showing us this? You can see that the importance of structure is not and cannot be completely eliminated. In fact, you cannot even eliminate it, because at the end of the day, it is the sole skeletal work of the market. Now, since we've been able to identify this, we also see that there was there a need for what this level to hold. So it means that we are still what bearish overall. So it then makes sense for us to have looked for entries at this previous support become resistance, because now it's valid, because overall there are more bears in the market than bulls themselves. And having known that we've broken the last point where bulls were, the bears would need to prove themselves again. They need to revalidate themselves again and to actually enter the market. So after saying this now, we know that we've done what? We've created another sell side here to the downside. So what do I want to then look for again? I want to then identify, was this able to break another structure? Yes, it did. This was the lowest point at that very point in time here. And since this was the lowest point at that point in time, it means that this is now a good valid lower high. Why? Because it was able to take out a previous lower low. So this is why this is now a bearish structure. So looking at this now, I can then go further to then say, okay, so since we're still bearish, and I know that the market is bearish, I would not be one to be so attracted to the buys at the very moment. So I would want to plot what a possible continuation again for what? For the sells, knowing that this was a previous support level and is broken and could act as what? In a new resistance if prices hold well against it. So what do? I sit and I wait for what? Confirmation. So what confirmation am I looking for? A failure for prices to break above this, or if for prices to break above it, fail to stay above it, break below it, and then go back to retest it again. So for every time prices breaks a level, okay, and comes back below it, there's a need for prices to revalidate that level again or retest it to prove that it is no longer worthy enough to keep going up or keep going down. But if prices breaks above it like this and comes here and goes here, then it's going up. But if prices breaks above it and comes back below it, you don't just jump into it. you wait to see that it goes and try to break it again, fail to break it, and then come back. Then you finally get an entry. So we can see similar thing happening here. Prices stayed here, but it could not continue going down. Prices then broke above it, and then also could not stay above it. And then what? Finally came below it again. And now we see prices trying to go above it again. So now next in question is, would prices eventually go above it, or would prices eventually come back below it? And if prices does come back below it, then we can then find to execute the trade to continue lower. So that would then mean that what? Our structure is still in place. So what am I saying presently? What am I seeing presently on this market here? Okay, what I'm seeing presently here is, and now this is where I then start to study the candlesticks as well. Okay, so here at this very point in time here, what do I see? What do I see at this point in time? I see this huge bearish engulfing candle happen here. Will it hold? I don't know. So what I would do is then I would then go to the 4-hourly time frame as well, and then try to understand the structure at this very point in time. Here, I see that there's been a huge move to the downside, but I also see that prices have not created any new higher highs. Okay, and prices have also not taken out the previous 4-hourly high and low at this point in time here. So there's a need for me to play it safe around this region until I get a very good confirmation before I eventually decide to know if I want to buy or if I want to sell. Okay, does that make sense? If you have any questions, as always, leave them in the chat section and I will pay attention to them. Okay, so this is me trying to identify structure right now, okay, on the USD CHF. So another thing we also need to look out for is this level here. Is it coming from a very great area of demand as well? So you also want to mark that out, and then go to your higher time frame. Remember, we mentioned something about higher time frame because higher time frames are very important. And in fact, we can see that prices is actually reacting from where a previous level on the higher time frame that prices have rejected back into. And that's where these buyers are coming from. So it then means that overall, we need to watch out to see how this level holds and if the market is planning on what distributing from this phase. So we might get some sort of accumulation again, and then a markup phase is possible at this level. But when we now put fundamentals and all of those things together in present market conditions, we see, Powell talking about a possible rate cut coming in a few weeks time, or in a few months time. It means that it might actually start to put pressure on the dollar to want to get weaker. So if that happens, we might actually just break through this demand zone, but it doesn't necessarily mean that it's going to break immediately. So that's the thing. When you forecast with fundamentals, you don't expect it to happen immediately. You want to give it time to breathe and wait for the actors in the market, that is the who, to actually take charge. So now we know why the dollar can be bearish, but we don't know who would make it bearish at this very point in time. But we also know where it might get to when it's bearish. So something is still missing overall in my full-fledged analysis. That is the actors, that is the who. So until we actually see that cut, I cannot fully tell if investors are going to, start to, borrow more money and the dollar is going to weaken or not, or any of those kind of things. We don't know yet. So we don't know if investors are going to be more interested in the market. If the market gets bullish, investors will be more interested. If the market becomes dovish, we would see a lot of businesses and borrowers be more interested in the dollar. So all of these things are factors influenced into the market as a whole. Okay, so that is that for USD CHF and how I view USD CHF. So let's look at something more trivial. Okay, if you were following the analysis, the outlook for this week, you clearly see where I stated that we're going to be expecting some bearishness to the downside on GBP USD before a continuation of the present bullish momentum to the upside. And that's exactly what happened today. We saw the short-term correction intraday, and we're going to be seeing a continuation of those buys very soon, hopefully. I do not dictate the market, and this is just a trade idea. So that's what's happening right now. But now let's look at the structure overall. So I'm going to go to a different. Okay. So let's look at the structure overall here. So I want to go to the daily time frame most times, and then I want to view. So when you look at this right now, what's the first thing you can see? For me, I see a bullish structure. Why? I see one, okay? I see two, out. And after that, I see three, out. And after that, I see four to the upside, out. I see here, out. I see prices come all the way back here. Okay. But now something happened here. There was a demand, another block here that actually led prices to the downside. But what happened? Prices stayed here. But you see that overall, prices did not break the last key move, which was this level here. It did not break the last key low because this low here was responsible for actually taking out this higher time frame. This is where the weekly structure is from. So this was responsible for taking it, and it was never invalidated. So it meant that we still kept the bullish structure. And what do we see? Prices tapped into that other block here, and what started to push to the upside. So what have I been able to do? I've been able to identify that we are still what? We are still bullish overall. So now this helps me keep my trade idea in what? In the direction of what? Of the trend. So I know that wherever sales are happening is possibly going to be a short-term sales until the structure is invalidated. Then we'll then start to say, okay, probably we're no longer bullish and we're starting to shift bearish. Okay. And when you look at this level here, what does it remind you? It reminds you of some sort of what? Some sort of distribution phase. So unless this distribution phase holds, then we can then get the markdown. But for now, we are still bullish as always. Okay, very simple, very easy. Now we're going to talk about on knowing when structure shifts and when structure still stays in place, knowing when it has moved from a bearish to a bullish trend. But it's not just going to be on this webinar, because at the end of the day, the beauty of knowledge is it being unpacked and unraveled gradually. So we're going to talk about that in a future webinar, and you should be present for it because you're really going to see the mistakes that a lot of people make when it comes to actually identifying when a structure has changed or not. Because sometimes we pay attention to the wrong structure and we tend to, liken it to the right structure, and it's wrong sometimes. When you want to view structure, I always advise that you use a higher time frame. Because why? The higher time frame is the gear of that car. It tells you that, okay, this is where we are going to overall. But what the smaller time frame does for you is just really shows you the process it takes to get to that destination. So if you can know the destination, if you can know the where and you know the why, then you go to your lower time frame to then find your entries. Does that make sense? Okay, so that is that for structure when it comes to actually identifying structure and how I identify structure. So let's say I want to take a trade, for instance, on this trade now, okay? What I'll do is, since I've identified structure, I like to play a game on candles, okay? So if I identify structure, now we have this low holding. I can see bullish, 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 bullish all the way here. So all these candles are bullish candles. And as always, like I said, when you have the impulsive, you have the correction, and then you have the impulsive again. So now we have the impulsive, we've gotten the correction. Okay, are we going to get a deeper correction before we get the impulsive? We don't know yet. But we've had this correction here, and we've also had an impulsive move that broke above it. So we might continue to go higher. And not only that, but this stopped where at a key level. Why? We have a turning point, and then we also have a turning point. So this is actually a key level here. And this is where prices have stopped at the very moment. So we have resistance, support at the very moment again as well, because prices broke through it, came back to it, and then looked like it has bounced off above it. So let's clean this. So what I would do now, if I want to make an entry, since I've identified what it looks like on the higher time frame, I will then go to my 4-hourly time frame. When I go to my 4-hourly time frame, what would I then start to look for? I would then start to wait for confirmations and entries to actually see why I should take the trade. So we see that on this part here, we've we've been bearish here. Okay. Since we've been bearish here, it means that this is an internal structure. See, in our next class on structure, we're going to talk about things like internal structure, macro and micro structures, how to look at structure and know when structure has shifted and all of those things. So you get it better. And then I see that this huge impulsive move has happened. Obviously, I know this is a huge imbalance. I expect prices to reprice it, okay, to kind of retest and then continue to the upside. So what would I be looking for? Is I'll be looking for reasons to why I want to enter this trade. Then I can go to the smaller time frame, like the 15 minutes time frame. Okay, on the 15 minutes time frame, I can easily see that prices have shifted what? Bullish aggressively from this previous bearishness. So we had all these lower highs and lower lows coming to the downside. Then we had this huge higher high created. So what happened? We now have a break of structure here. So we now have a break of structure here. And since we have a break of structure at this point, what am I going to be expecting? I already have a low here. So what do I need? I need a new lower, I need a new what? Higher low. So if I can get that higher low, okay, so what I would then do now is also identify a smaller time frame key level, okay, or a smaller time frame valid support and resistance. So we had resistance here, resistance here, resistance here, resistance here, support at the same level here. Can you see it? So resistance, resistance, support went to the upside. Okay, then I can then plot my support and resistance at this level here. Okay, and also wait and see. So I have resistance, resistance, support. I have support at this level here. Broke through, broke through. So it means that what? We need to revalidate these areas again. So this whole area like this for me now is going to be a very good area to see prices slow down and start to give me bullish confirmation. And when I get that here, I can then use price action here. Look for a good price action candlestick at this level. Add my confluence like my RSI. And what can I see here on my RSI? I see that my RSI is extremely oversold, but is yet to cross this level. So the moment it is oversold and I get it to actually cross this, my median moving average, and stay above it, then I would have gotten confluence. Then what would I also want to do? I also then want to look at the news. Since we have the news coming out, if we have a news tomorrow, say Tuesday, is it going to be for the dollar or for the pound? I try to want to analyze it. And then, for instance, let's say the pound CPI is high. I know that the pound is going to become very bullish against the dollar. So that is also going to propel and ignite my trade entry to the direction that I wanted to go to. Are we following? And I hope this makes sense. So this is the easiest way and simplest way that you can fully understand structure, how to make your entries, and how to actually manage your mistakes around it. And I hope we all followed. If you have questions, I believe we can head back to okay. So the reason why setups feel really sometimes is, I've said this thing before: fear, greed, stress, no proper edge or clarity, emotional fatigue. So a lot of times you just want to trade. We really don't even have a setup. We don't have a reason why we just want to trade, because we're either trying to chase money, or there's this dopamine feeling of, oh, I'm a trader, I can trade anytime, I can make money on my phone anytime. Those are some of the reasons why we actually lose trades. Another one is fear. You might be in the right trade, but then something triggers your emotion, triggers fear, and then that happens. It could be greed. You're already on a trade, making a lot of profit, and then you decide to want to, double down on your risk again. And emotional fatigue is real. Personally, for me, when I'm tired or stressed, I try to avoid trading. I do my best to avoid it. I have grown out of the phase of wanting to trade every day. I could trade once a week and I'm good with it, honestly speaking. So for as long as, you know, I know I'm tired and I would not be able to have the clarity I require or desire to trade, I'm not taking a trade. Okay, so these are some of the reasons why setups, in fact, do fail. Key takeaways would be, always start your analysis from structure first, like I just did. Use the higher time frames. It give you clearer structure, lesser noise and everything. Use the smaller time frame to, enter your trades. And most importantly, structure tells you when to wait and when to strike. It lets you know what phase of the market you're in, if you're in the pullback phase or you're in the impulsive phase. Okay, it helps you know that once you can identify the structure. And here are my call to actions for you today. Always review the market before you go to trade. So if you'd like to trade London session, don't try to analyze the market during London session. Try to analyze it during the Asian session. If you like to trade New York session, try to analyze the market during the London session ahead of the New York session, so that way you always position yourself just a tad bit step ahead. Okay. Focus on journaling your trades. If you are not someone to use physical journaling, there are a lot of journaling apps you could use. You could create an Excel sheet for yourself to help you journal as well. Then have a daily checklist for entries. What are the things that you need to see before you take a trade? You need to also have that. For me, I do a lot of mental journaling, especially when it comes to my emotional notes. I do them a lot in my head. So I can tell you how I felt on every big loss and how I felt on every big win. I can tell you what my biggest win was, and I can tell you what my biggest loss was. I can tell you what my biggest mistake was, and I can tell you what my biggest aha moment was. So things like that, I do a lot of them mentally. I use it to kind of train my brain, but it works different for different people. I'm not imposing that you do that. In fact, I would advise that you focus more on the physical journaling than just the mental journaling. And that brings me to the end of our webinar today. And I hope that you really enjoyed your time on the webinar. You were able to learn a thing or two. But as we always do it's the Q&A session time. So I'm just going to go through our chat session now and see what we have in the chat box. Okay. How can I plot the moving average and RSI? How can I plot the moving average and RSI together? Okay, so one thing the moving average. So when you use the chatting platform, which is the most popular chatting platform, I guess you already know what it is that I'm using. All you have to do is just turn on your RSI and then go to your settings. So let me see if I can just share that to you, okay? So all you have to do is go to your RSI. When you come here, you come to settings. When you come to settings, you will see the RSI length. And then when you go to style, you see the RSI based moving average. Okay, so you just want to turn on the RSI based moving average. Okay, that's how you add the moving average to your charts. Okay, and it's that simple. That's how you add it to your charts. So do we have any other questions from anyone? If you have questions, okay. So if we do not have any questions, I want to believe that we enjoyed the webinar and the session. If you did enjoy the webinar and the session, please just leave an emoji or type Valetax or type 111 for me in the chat section. Let me be sure that you were following and you enjoyed the session and you were able to grab a thing or two from market structure part 1. Thank you guys so much, so much, so much. Let's have it. Let's have it. Regardless, a good setup. What's the best lot size you'd advise for $100 account size? Honestly, 0.01. 0.01 is the best I would recommend for you on $100 account size. So that way, even if you take multiple trades and probably your stop loss at 30 pips, you're not losing more than, 6 to at most 10% of your account, which is fair for a $100 account. So that would be my best advice. Okay, thank you guys so much for joining the webinar. It was an amazing time being able to impact and educate you guys. And thank you from all of us here at Valetax. And we hope to see you again on the next webinar. And don't forget, if you're still yet to open an account with Valetax, it is important for you to just go to www.valetax.com and sign up to get registered. Our ECN account with zero spread, starting at zero spread, goes for a base fee of as easy as $50 minimum deposit, and you will get what every other broker is asking you to deposit $500, $1,000 to get, all for $50. And trust me, our withdrawal and deposit as fast as possible. When I mean fast as 5 to 15 minutes on very good days when the NIBBS is not messing up. And when I mean NIBBS, you already know what I mean. Okay. That's the banking system operators. Those are the main reasons why withdrawals can be slow sometimes. So don't forget to actually get signed up and start trading with Valetax. And as always, I would see you guys in the next webinar. And this is Ryan from Valetax. See you guys next week.